Let's try out some of the exercises. Well, before I start doing the solution, I would like you to give it a pause. Try to solve by yourselves and then unpause, and then we will do it together. Again, if it doesn't work out for you, it's fine. At least give it a shot, and then we will do it together. Okay, now I hope that you've already completed it or at least given it a shot. Let's try to solve it together. What it says, a retailer pays on credit for $650 worth of inventory. The terms are clear, 3% if paid within 10 days, and if not, so after the 10th day, within 40 days, you have to pay the full amount. The retailer must pay the full amount. If the merchandiser, meaning the retailer, again, don't forget this is the same word, retailer, pays within the discount window, how much will the retailer remit in cash to the manufacturer? So what do we have here? A retailer pays on credit 650 worth of inventory, yeah, $650 worth of inventory. So in the beginning, so before all of this has happened, we had the fact that retailer bought something for $650 on credit. Buying something on credit means that they have bought by something, it's usually merchandise inventory. Merchant inventory was purchased for $650, and we had an account payable because yeah, so it was bought on an account. Now, there are no dates, but let's assume that this is September 1. September 1, the purchase has been made. Now, if we assume that the payment has been done within the discount window, within the discount windows at the latest, it was paid on September, let's say, 10. Yeah, so that's the discount period. So in this case, what we will have, again, I'll just try to put it here so you can see the difference. The account payable is going to go down because we pay the cash, and that means that the payable account is going to go down. So this amount is going to go down. Yeah, so 650 through the debit. Then what we have here is cash, one account, and that was $630.05. That's the discounted amount. So if you have trouble understanding this part, so 650 minus the 2% of the same, is it 2? Sorry, 3%. 3% of that amount. So that's going to make $630.5. And our merchandising inventory is going to go down 19.5. Why? Because eventually we didn't pay 650, we paid 630. So this amount that we first registered has to go down 19.5. And it once, by the way, if you do, yeah, eventually when you do this, it's going to be 630.5. But please don't confuse it. At this moment on September 1, it was registered at 650 because it wasn't known when it will be paid. Yeah. So, and if we assume that it was paid after September, let's say 11, that's after the discount period, after 10th, then it would be very simple. Account payable would be same 650, and our cash would go 650. Yeah, we would have to pay the full amount. And merchandising inventory would still stay 650 and not go down 19.5 because eventually, if the payment was done on this day, then there would be no discount. Okay, so I hope that was easy and very light to understand eventually. Let's move on to the other exercise. Again, give it a shot and we will do it together. So give it a pause. Once you've tried or given it a try, let's try to solve it together. I hope you've already done it. Now, a retailer obtains a purchase allowance. So we're talking about the purchase allowance. Again, it's all from the perspective of a retailer. Just in the previous exercise, it's all from the perspective of retailer, all of the entries. Now, they obtain a purchase allowance from the manufacturer in the amount of $600 for a faulty inventory part. Allowance means that the inventory count count stays the same. However, the value of it is going to go down because we're given this allowance for the faulty part. Yeah, so this is a faulty inventory part. So what is going to be recorded? Very simply putting it, yeah. So if we assume that the payment has not been made yet. Yeah, so it's still not paid yet, not paid yet. So we're talking about account payable. Now, account payable, again, if we assume that there was some kind of purchase made, so account payable, merchandise inventory increases and account payable increases through the credit. So now that the allowance has been made, the retailer has to pay $600 less. Yeah, so we have to reduce the account payable account by 600 through the debit side. Yeah, this is a debit side. And what else goes down is our merchandising inventory. Merchandising inventory. Oh, sorry. And merchandising inventory is going to go down also $600. Now, if this, again, so this is the perpetual inventory method. This is perpetual. If the perpetual inventory system, this is what the entries we do, because in the perpetual inventory system, merchandising inventory is the one that continuously gets updated. But in the periodic one, we do not get merchandising inventory sort of updated during our purchases. We do it at the end of the period. So in this case, it's going to be, if it's periodic method, this is what's going to happen. Account payable is still going to go down $600, and we will credit it to return purchase. Sorry, I forgot to add purchase. Purchase return and allowance. I'll just write it here, allowance, and that's going to be credited to purchase to the credit side. Yeah, so this is the difference of this one. So in here, I know some of you may have gotten confused as, I mean, why did we do perpetual? How do we know which one to do? Again, during the exam, I will be specifying which methodology I want you to do. So if I say, what are the journal entries if we assume that it's perpetual inventory? If I want you to do periodic one, then I will specify it as well. So please don't overthink that. I hope that you understand the entries. Next one, on March 1, Bates Board Shop sells 300 surfboards to a local lifeguard station at a sales price of $400 per board. The cost of Bates is $140 per board. The terms of the sale are this. So within 15 days, they will get 3% discount. Otherwise, they will get no discount and pay within 30 days. The invoice date is March 1. Now we have to create the journal entries for the Bates company, meaning this is our retailer. Yeah, retailer. And again, they sell it. It means that this is a sales transaction. Don't ever forget to identify who is your retailer and which type of transactions they are doing. And again, we're doing our journal entries from the perspective of a retailer. Whether it's a purchase or not, it's for you to identify from the condition of the exercise. And in this case, obviously, it says sales, so we know that this is a sales transaction. Now, the initial sale, you're very familiar with it, so A will be recorded as initial sale. So the Bates sells so clearly, if there is this term, it means that the sale was not made on cash, it was made on account. So for retailer, it's going to be account receivable. How much? 400 per board. There are 300 surfboards, so this much. And then the sales account is going to be increasing through the credit side. This is the initial sale. Now, if we assume that this is, again, perpetual inventory system, so if it's periodic, this is all you have to do. But if we assume that this perpetual inventory system, then you will also add the cost of goods sold increase and merchandising inventory decrease. So the cost of goods sold will be $140 multiplied by 300. So that's going to be, how many? Yeah. And merch inventory decrease through credit side. So this is basically it, what you have to do for the perpetual inventory system. And again, if it's only periodic, this is the top one entry, that's enough. Okay, now we're going to go through the solution for B. Where is it? So subsequent customer payment on March 10, and that is going to be just a second. So we're talking about, again, don't forget, we're talking about it from a retailer's perspective. So retailer gets paid now, and because the customer pays within the window, they get a 3% discount, and therefore Bates receives not the full amount, not 120,000, but that amount with the discount. So that's going to be cash in. So that's this much, and that's again, so this is, if we break it down, that is 3%, yeah, deduct 3%, that's cash debit in. And because they for Bates, this is a sales situation, sales discount situation, sales discount is going to be debited 3,600, the difference between the full payment and the discount payment, and our account receivable, meaning the Bates account receivable, is going to go down the full amount, 120,000. So this is basically, this is how you record the subsequent customer payment. And please note that it's exactly the same entry for both perpetual inventory system. Yeah, so this is perpetual inventory and periodic. They have the same entries. That's basically very simple. Moving on to the next exercise. Again, give it a shot, unpause, and we'll do it together. I hope you've done it. Please unpause and continue doing. Yeah, so I hope you've done it. Let's see. On April 5, a customer returns 20 bicycles with a sales price. So we're talking about a return situation. And again, per bike to Barrio Bikes. So Barrio Bikes is a retailer, and for them, this is the retailer. So from their perspective, we're talking about the entries. Yeah, we're going to do the entries according to perspective of Barrio Bikes. Because the customer returns, we're talking about the sales return situation. So 20 bicycle with a sales price of 250. Each bike cost $100 to Barrio Bike. The customer had yet to pay on their account. The bikes are in a sellable condition. Please prepare the journal entry to recognize this return if the company uses perpetual or periodic inventory system. And this is it. We're not talking about the initial sales process, but we can actually still go with it. Yeah, so initial sale was what, 20 bikes. I mean, we don't know how many bikes in actuality they sold. It could be only partial return, but if we assume it's only 20, full price was full amount was 20 bicycles, then the sale would be so account receivable account receivable would be yeah, 5,000, while the cash sale, sales is 5,000 here, and that was the total initial transaction. And now if you're looking at to the so the sales return situation from the perpetual inventory system, here, okay, so let me just show you the other one. The reason why in the early example we didn't have any change, there was no difference between periodic and perpetual inventory system, because no physical return of inventory happened. They only received the sales discount, therefore there's no effect on the inventory. But in this case, we actually get back again, this is physical return, yeah, return of our inventories. So that's why it's going to be different. So a perpetual inventory system, we get the bicycles back, so it means that and oh, by the way, in the perpetual inventory system, so this is periodic, and in perpetual inventory system the cost of goods sold would have been how much is it, 100, so 2,000, whereas the merchandising inventory would go down 2,000. And Now we're going to the entries of the returns. So merchandise inventory increases again through 2000. Yeah, so we have to do that. We have to recognize the change. And cost of goods sold also goes down 2000 because no sale eventually for those two when bicycle happens, they come back. And at the same time, if we talk about our account receivable, yeah, so we are owed now less receivable, 5,000 less. 5,000 less. While we do not make any entries to our sales account, because our sales account has a so another account, sales return and allowance account. Please just excuse my abbreviation because I don't have enough space. Return and allowance account, sales return and allowance account, which will get effect. Oh my god, I'm sorry. I just realized my mistake. So it's supposed to be opposite. Just a second. Let me just fix this mistake. I hope you noticed my mistake earlier. That would make me really happy. So it's supposed to be sales return and allowance going down through the debit, because this is a, let me just point it out, this account is a contra revenue account. Means that they have an opposite increase side, so they increase on a debit side. This is a debit side, and account receivable is going to go down through the credit side, 5,000. So these are the entries that you have to do. So if this is a perpetual inventory system, you're going to do both of these entries. If this is only periodic one, then you will do only this part. Yeah, so the bottom part, the sales returned and account receivable entries. That's it. So I hope this is easy and very clear to understand, and you will have no trouble to repeat these exercises using other examples and pass the exam very successfully.